Folks, we're going to start in about 1 minute, but has anyone seen my car keys? I think I left them near the doorway when I came in. I was so busy trying to get ready for the webinar. I'm not sure what I did with them, but if anyone sees my car keys, please let me know. Now, we're going to get started in about 30 seconds. And let me warn you, this is not going to be a very good presentation. I don't know about you, but I'm going to probably take a nap and send this to Timmy, T-E-M-I, and then Timmy will type it up and I'll be able to read it later. That's a lot more effective than watching this guy. He's very boring and actually doesn't know what he's talking about. He's an actor and he's reading this as a script. And when you ask questions, it's actually me answering them. So some of the content will make your head spin. By the way, I'm not a real person in a costume. I'm actually just a dummy, like a lot of you. Okay, so without further being due, and therefore, and notwithstanding anything to the contrary, here is Alan Gassman, and we apologize in advance for his lack of humor and preparation. Welcome to Spousal Limited Access Trusts. Now, I already got a lot of comments. Am I going to talk about the limitations of your spouse? No, I'm not going to talk about the limitations of your spouse because your spouse already called me and we talked about the limitations of you. So that is not what spousal limited access trusts are about. Spousal limited access trusts are a very effective tool both for estate tax planning and for creditor protection planning, and also to make a solid commitment to your present family, whether you may want to or not. And we're going to talk about all of those very interesting items and the math behind it. And then in 59 short minutes or long minutes, depending upon how you're doing, Dr. Raul Rosden is going to come and talk about estate planning. And if you want to learn something new about your own profession or business, ask someone who's really brilliant, who doesn't know anything about your business, to come in, study it, and tell you what his blink is. What do I mean by the blink? If you've ever read the Malcolm Gladwell book, Blink, or if you haven't, at least read the Wikipedia entry about it. It's instant knowledge that people get. And Dr. Rosden is going to talk to us about that. And he's also a funny guy. And we're going to talk about my favorite poem, The Love Song of J. Alfred Prufrock, and how that implicates Tesla and donkeys. So watch out. And if you can't get to this in an hour, you can watch it later, or you can read his article in Forbes because he's a Forbes contributor. So every week I get an email from a CPA, can I get continuing education credit for this presentation? I'll be glad to give you a certificate of attendance if you attended, but I can't get you credit because the presentation is not good enough to receive credit. If you have questions, what should you do? First, ask the dummy, but if you can't get the dummy on the phone and he's busy looking for his car keys right now, then go to the question panel. It's the inverted pyramid. We didn't have any room to put the Stonehenge up there. But anyway, then you can type in your question. I've already got 2 of them from Noli, and I'll be answering them as I can. Okay, shameless self-promotion. Please join me next week for Asset Protection meets Estate Tax Planning, because the 2 are sometimes together and sometimes contrary. And then the following, we're going to talk about hot topics and best strategies for estate tax planning. And my friend Marty Schenkman is going to join me for the human aspects of estate tax planning. Then the 23rd, estate tax planning for the wealthy. If you know anyone wealthy, have them tune in. And then April 30th, we're going to talk about dynamic planning for professionals and their entities. So start sending me your questions and ideas for these presentations, and I will make sure I mention what you want to have mentioned. Also, if you're a CPA, first, you have my condolences. Secondly, what are you, crazy watching this when you should be doing tax returns? And third, on March 30, Bradley Burnett and I are going to talk about the new S Corporation reporting rules. I'm going to introduce him, and he's going to do all the lifting. He's very, very bright, and you'll learn a lot from that presentation. If you're an S Corporation owner, or you're a CPA, or you're into S&M, any of the three, you'll get a lot out of this presentation. So more shameless self-promotion. Now let's talk about what is a SLAT. SLAT stands for Spousal Limited Access Trust or Spousal Lifetime Access Trust. It is an irrevocable trust that I can form to get assets out of my name, out of my estate, out of the reach of my future creditors, but my spouse, who I am required under the document to love, cherish, and respect, can receive benefits from the trust. Now, my spouse doesn't have to receive benefits from the trust, and for most of our wealthy clients, the SLAT is never touched by either spouse. But if things get tough from a financial standpoint, or, I don't really like my kids that much anyway, let's just spend the money in that SLAT, or we really need it, whatever it is, the spouse can receive distributions from the SLAT. And I don't know about you, but if my wife, Marcia, got a check for $1 million from a SLAT, somehow that would benefit me. For example, she could pay half of our household expenses, and then that would lower the financial pressure on me. She might loan me money at arm's length. So that is the key component of the SLAT. If you're going to give it away, you want to attach as many strings as you legally can without causing creditor exposure and without causing estate tax exposure. And how do you do that? Well, under the estate tax law and the creditor law, it's not easy to say, oh, and I get it back when I want it. That's not going to work very well. But to say, well, if my spouse needs it, then give my spouse what is needed. Or if the special trustee, we'll talk about the special trustee later, if an independent trustee decides to give it all to my spouse because I'm really mad at my children, then that can happen. So that is the Spousal Limited Access Trust. Now, these get confused with charitable lead annuity trusts, which is a trust that pays an annual fixed payment to the person. This is not an annuity trust. It's an access trust. You would also not confuse it with a charitable remainder unitrust, which pays a percentage of the assets each year to the beneficiary. You could provide for the percentage of assets each year to be paid to the spousal beneficiary, but then you would have to call the trust a slut. And you probably would not want your children to ask you why you formed a slut for your spouse. Just a little bit editorial remark there. Okay, page 13. The grantor spouse is the one who establishes and funds the SLAT. So if I'm going to be the grantor, I take my assets. I don't take Marcia's assets. First of all, she wouldn't let me. But secondly, it won't work that way. It has to be my assets. I establish and I fund the Spousal Limited Access Trust. And then there is the beneficiary spouse. That's Marcia. She may be trustee of the trust and may be able to get, without permission of anyone, whatever she needs for her health, education, maintenance, and support. So the grantor is me, the beneficiary is Marcia, and we're going to be using that terminology. Now, here is an older chart, because normally this would now say spouse one and spouse two instead of husband and wife, because not everybody is a husband and not everybody has a wife, but many people are still spouses. So a typical arrangement would be the husband has a revocable trust, the wife has a revocable trust, they have joint assets, they may have a joint trust, especially if they live in a community property state like California or Texas, and then all this stuff is in their estate for federal estate tax purposes. And if they live in a community property state, all this stuff is exposed to their creditors. So let's say that in this situation, the wife is a neurosurgeon and the husband sells life insurance. Well, naturally, the husband is much, much wealthier than the wife. So the husband has a lot more assets than the wife, and the husband would like to save federal estate tax because he happens to love their children, at least for the time being. So he establishes the lifetime bypass trust. That's what this was called when I created this slide about 25 years ago, because I didn't know it was called a slat. So the husband makes a large gift, say of $1 million, to the lifetime bypass trust. And then the trustee of the lifetime bypass trust can be the wife. She can access it as reasonably needed for her health, education, and maintenance. She can direct where it goes by having a power of appointment. That power of appointment might, M-I-G-H-T, be exercisable back in favor of the husband, directly or indirectly, as long as there is not a preconceived plan or agreement to do that. We'll talk about that later. The husband may control the assets under the trust. How does he do that? He sets up an LLC underneath the trust. He is the manager, the control freak. He has a fiduciary duty to manage that LLC, and he puts the $1 million into that LLC. That LLC then goes and finds a hotel opportunity, puts $1 million down, borrows $3 million from the bank, and now you have $4 million. It grows to $8 million. Pay the bank off its $3 million. Now you got $5 million in the slat. It's creditor proof from both spouses because the husband doesn't have a beneficial interest in it and the wife didn't form it. And what could be better in life than to have a spousal limited access trust? So let me show you something more dynamic, and that is on slide 16, the installment sale. And I'm going to go over this 2 or 3 times during this hour because repetition is helpful. And because I'm forgetful and I'll forget I did it before. But anyway, you have a happily married couple, and what they're happy about is that they have $20 million of income producing assets. And even better, they don't need nearly $20 million to support themselves for their lifetime unless something bad happens. So they put these $20 million worth of assets into a limited liability company, and they keep 1% ownership and the control. That's what the V is for. That's V stands for voting. And then husband in this example, or spouse 1 in this example, owns 49.5% non-voting. See, a lot of people think that NV stands for North Virginia because he's from North Virginia, but actually it stands for non-voting. So what is a 49.5% non-voting member interest in an LLC worth? Not $10 million, not $9,800,000 and some odd $1,000. It's probably worth about $7 million. We get a valuation report which says it's worth $7 million. And then he makes a seed capital gift of $700,000 to the Spousal Limited Access Trust and sells the 49.5% interest to the trust for a note. And right now, the note would have to bear interest at about 2% on a 20 or 25-year note. Typically, the note is for just a little bit shorter than the life expectancy of the seller. So we've taken now $10 million worth of assets. We've reduced them to a $7 million value, and they're only going to grow at 2% a year. And if we need that excess value, it can be spent on the spouse. Now, you might want to say, Which spouse? The spouse he's married to now, or the spouse he's going to be married to later? Maybe you know something I don't know. So the answer is most of the clients have us draft it whereby if the client is single and not married, then the trust will benefit any future spouse. The first one and the second one, the third one and the fourth one. And then you remarry the second one again, and that is the beneficiary. That's called the floating spouse. The floating spouse looks good in a swimsuit, apparently, because they're pretty popular. So other way to do it is, wait a minute, this is our marital assets. We've been married 27 years, and boy, does it seem longer than that. So if I'm cooperating in this process, I'm going to be the only spouse. And if there's a future spouse, they're not going to get anything out of this trust. So that is the death of the floating spouse, or I guess the drowned spouse. So as I said earlier, the SLAT has to be funded only from assets of the first dying spouse. I'm sorry, of the spouse who is the grantor. So what do you do with the other spouse's assets? The other spouse could set up a trust for descendants only. The way we do it, because of something called the Reciprocal Trust Doctrine. If I set up a trust for Marcia and she sets up a trust for me, first of all, I'd be very surprised if she ever set up a trust for me. But secondly, the IRS may come in and say, Alan, you really just did a trust for yourself. Marcia just did a trust for herself. The estate tax law is clear. If you just form a trust for yourself, then it's going to be subject to estate tax unless you go through a lot of very careful machinations and put it in an asset protection trust and sprinkle pixie dust on it and leave it in vinegar for a week and all those other things. It's just safest that I form a trust for Marcia and Marcia forms a trust for our descendants. And then she makes the same type of sale to that trust. I'm not going to be a beneficiary of that descendants trust unless certain things happen that are not expected to happen. And we'll talk more about that later. So what happens 10 years later? If you invest wisely, on average, the assets will double in value every 10 years. I can give you a lot of statistics for that, which I just made up. But that's pretty much accurate. A 7%, 7.2% rate of return gets you a doubling of assets every 10 years. So then when these assets are worth 40, if you dissolve the LLC and repay the notes, each spouse gets about, each trust is now worth about $13 million. So remember, we made a $700,000 gift to each trust. We used $1.4 million of the client's estate tax exemptions. And now each trust is worth $13 million. We got $26 million removed from their estates using a SLAT and a descendants trust. There's one more thing I want to mention. If you want to be safe when you do this, this is just another way to look at it. You've got the SLAT and the descendants trust. Have another member of the LLC with the exclusive right to make distributions or liquidations to avoid a problem under what we call 2036A2. And we call it 2036A2 so that everyone thinks we're really smart and that they need to hire us to understand the estate tax law. But basically, if you give something away, but you control the right to determine when it's going to be enjoyed, then it may still be in your estate. And that's in a court case called Commissioner v. Strangi, Strangi, and Powell, Powell v. Commissioner. So those are just some things we wanted to talk about. I want to also mention that while the classical SLAT is just a trust for the descendants, for the spouse and descendants from the beginning, you can do a GRAT slat. So in other words, if I'm going to do a grantor retained annuity trust, which is a different instrument that we commonly use for the wealthy, I can put, let me see if I have a good slat, a GRAT thing here. I thought I had an intro. Okay, I guess, oh, here's an intro. So here's how a GRAT would work. I put $4 million of my own hard-earned money into a grantor retained annuity trust. The grantor retained annuity trust promises to pay me $1,976,000 in year one and $2,372,000 in year two, and anything left in the GRAT after that is held for my spouse and descendants. So my spouse can receive whatever she reasonably needs for health, education, and maintenance if she is the trustee, and then off it goes to our descendants upon her death or as she appoints it. So now let's say that instead of $4 million cash, I put in percent ownership of an LLC that's worth $12 million. So 40% of $12 million is about $5 million, but after discounts, I can value that at $4 million. So after these two payments come out, there may be significant value. And when you do the GRAT, unlike the installment sale, where if the IRS comes in and says, hey, I don't like your numbers, I think you made a gift here, with a GRAT, the IRS is not really able to do that. They simply can make you pay more back, so there's not as much of a gift tax risk. So I think I've just completely mutilated trying to describe how a GRAT works, other than to say that if you're concerned that you may have to pay gift tax because your installment sale is so large and the IRS may say, wow, that $60 million note should have been an $80 million note, you owe us gift tax based on 20 million. If you do something like that with a GRAT, they cannot charge you gift tax, they just have to have you give more back. So that's a GRAT example. A numerical example that I think the advisors out there who are still awake may want to see is I had a client come to me, they have a residence worth $1,250,000 and they have investments of $14 million. Now this is before paying my fees. They have $1,250,000 and then the investment's worth $14 million. After they pay my fees, they're going to be like at $13 million, something like that. Well above $13 million, but not at $14 million anymore. Well, in 10 years, if the residence and the investments double in value, which they might, and if their exemption is only $7 million in this example, because the estate tax exemption goes down, then they're going to pay an estate tax of $6,600,000. That's pretty extreme, isn't it? And after 20 years, their estate tax is going to be $16 million. So they have a very bright financial advisor who said, hey, Randy, go ahead and put $3 million into a slat for Laura and the children. It's not going to impact your standard of living, and it's going to avoid estate tax. Well, how much estate tax is it going to avoid? Well, using my rule of thumb, if you put $3 million in, and by the way, the slat does not pay any income taxes, the grantor pays the income tax on behalf of the slat. So I'm going to put $3 million in. I'm going to pay the tax on behalf of the slat on the income generated from the $3 million of investments. That is not considered to be an additional gift for gift tax purposes. In 10 years, it's going to be worth $6 million. If I die in the 40% bracket, it's going to save $1.2 million. In 20 years, if it's going to be worth $12 million, 40% of $12 million is almost $5 million. Times 40%, it saves $2 million of estate tax. So we run those numbers and we look at them. And she was absolutely right. By 2042, the estate tax savings is really, really significant, as you see there, $3.6 million. So certainly we do recommend that they do this. But what if this same couple does an installment sale instead? husband puts $8 million into the family LLC. Then he gives a seed capital gift of $1 million to the gifting trust, and he sells the 99% non-voting member interest in the LLC for a $5,600,000 note bearing interest at 2%. In 2032, you see that the trust has a value of $12,400,000 after taking into account the note. So the estate tax savings here are significantly more. The total estate tax now, just after 10 years, is $2,160,000 versus before we had our estate tax savings at $1,200,000. And it becomes even more dramatic after 20 years. So I tried to explain this to the clients, and they are very bright, but a phone call didn't do it. So we prepared these charts, and I think these charts show that an installment sale to a SLAT is going to be much more effective than just a gift, but we do what we can. So here is the letter we wrote the clients. You can read it, correct our grammar, improve the explanation, but that is what it is. So let me see some questions now. The first question from Lori: client formed SLAT in 2018. Do we need to file a late Form 709? Yes. When you fund a SLAT, what you put into the SLAT is a gift that will use part of your $12,060,000 exemption. Then you file your gift tax return the following year, pretty much the same time your income tax return is due. There's an exception to that, and that is if I put $26,000 in the SLAT and I give our daughter 60 days to withdraw the $26,000 and she does not withdraw it, then that can be considered to be a gift that my wife and I made to the trust. Even though it comes from me, we can what you call split the gift. We both file gift tax returns which say Alan gave the trust $26,000. Nicole had 30 days to withdraw it or 60 days to withdraw it. She didn't when she learned that she would lose the rest of her inheritance if she did. Marcia agrees that that gift comes from Alan and Marcia together, even though it came only from Alan. And therefore, there's no use of Alan's exemption and no use of Marcia's exemption, assuming that we did not give Nicole anything else during the year, which is easy because we don't give her anything. So now, could I put $10 million into a SLAT and then file a gift tax return, and Marcia files one saying this $10 million, even though it came from Alan, from all of the profits from his webinars, it's considered to only come $5 million from Alan. It reduces Alan's estate tax exemption by $5 million. It reduces Marcia's by $5 million. And does that work? It's called gift splitting. The answer is you can only gift split under a SLAT if it is highly unlikely that the spouse who allowed the splitting would benefit. So if Marcia has a $40 million net worth and we live on $400,000 a year, then yes, we can split the gift. But if Marcia has only her furniture and artwork and her car and nothing else to live on, and it seems quite likely that on my death she would need to draw upon the SLAT, then we would not be able to split the gift. Now, what happens when you make a late gift tax return? The answer is just about nothing. Unfortunately, unlike a late income tax return, even for an entity with all zeros like an S corporation where there's a penalty, there is no penalty for the filing of a late gift tax return as long as there's no gift tax owed. And if your estate tax exemption was sufficient to absorb the gift made, then there's no gift tax owed. And if you have a late gift tax to file, I would go ahead and file it right away before the IRS is better able to thoroughly audit gift tax returns, because right now they are really flooded from last year's flurry of gifts. There's no way the IRS is going to be able to take an intelligent look at even 10% of the gift tax returns based on what I'm hearing, although I'm not a good listener apparently. So I would go ahead and do that. Karen says that I'm her humor break from tax returns. Karen, thank you very much for saying that, but I would recommend Abbott and Costello instead. They were the highest paid entertainers during World War II and after World War II. The only time in my knowledge that a comedian was highly paid. Okay, proof that I'm not a comedian. Okay, from Helen. When referring to the HIM standards, you didn't mention support. Is there a reason for that? Yes, because I'm neglectful. The HIMS standard is health, education, maintenance, and support. What does that mean? This comes from the British Commonwealth, the 1700s, imported into the original colonies. The English common law was that if you were limited to being able to withdraw money from a trust or arrangement, and you could only withdraw it for your health, education, maintenance, and support, then a creditor couldn't reach it. So when they wrote the estate tax law in the early 1900s, back before I invented the internet, they came up with the same words. They said, you know what, if someone sets up a trust for you and you have the right to withdraw from it, it's not going to be subject to estate tax as long as your withdrawal is not exercisable beyond what you need for health, education, maintenance, and support. But the words maintenance and support are very, very synonymous. So I use the shortcut, health, education, and maintenance, and my partner, Ken Crotty, always corrects me, and he'll be very glad that Helen corrected me. But then back to the common law, I can also have the power to direct where the assets go during my lifetime or after death, exercisable as long as not exercisable in favor of me, my estate when I die, my creditors, or the creditors of my estate when I die. Which means that I could fund a trust for Marcia, which will not be subject to estate tax in her estate, even though she has the power to direct those assets to anyone she wants in the entire universe. And I would bet that she could probably find somebody who would accept those assets and be very generous with her. So that is a really neat thing and a really scary thing. When you draft your slats for clients, do you want the spouse to have the ability to do anything and everything the spouse wants other than to take it out for himself or herself? Or do you want to limit it to health, education, maintenance, and support so that if somebody hits their head and wakes up not so smart and on methadone with a very nice nurse who wants to help you rip that trust apart, you can't do it by the terms of the trust? So that's important, and thank you for letting me go on that tangent. Okay, from David. If a couple living in a community property state that it seems that the slat doesn't work unless a transmutation agreement or the like, unless the spouses have separate property. Okay, if you live in a community property state like California and Texas, first of all, you have my condolences, because in most of those states, if one spouse gets sued, you lose everything. But the community property law says that if I have an asset that I earned during the marriage, I cannot transfer it to a slat unless I have the permission of my spouse. And that's okay. You, what we call, transmute out of community property status. And after you transmute out, then the spouse makes the contribution to the slat. Now, what if Marcia and I have $20 million in a money market account, and we also have a $20 million shopping center. We own them both jointly, and I want to transfer the money market to the slat. Well, the money market belongs half to Marcia. So if I do that, because I sign on the account, then she's contributed to the slat, and the slat won't work as to her half. On death, it'll be subject to estate tax in her estate unless you have an appropriate savings clause. So what I could do instead, though, is I transfer the apartments to Marcia. Marcia transfers the money market to me, and now I transfer the money market to the slat. So one of the things we do with clients is we say what goes best into the slat, and then what do we have to swap as far as assets in order to get the slat funded. And there's been times where we've simply had the grantor of the slat give a promissory note to the spouse. You know, if the grantor of the slat earns $1 million a year and wants to buy $5 million worth of assets from his or her spouse for a $5 million note, I think that's legitimate. So I hope that answers the question. Okay, Patricia, the slat is not a grantor trust, correct? No, the slat is a grantor trust. What is a grantor trust? A grantor trust is a trust that is disregarded for income tax purposes. So I put $5 million of stocks and bonds into the slat because it benefits my spouse. If my spouse is the trustee of that trust, it is automatically disregarded under the grantor trust rules. Or if I retain the right to replace trust assets with assets of equal value, it is automatically disregarded under the grantor trust rules. The question is, later on, if I get tired of paying the tax, or the slat is about to sell an asset for $100 million and the capital gains tax is going to be $18 million and I don't have $18 million, can I toggle off grantor trust status and make the trust taxable at its own brackets? And the honest to heavens answer is we don't know. It used to be that you could toggle off a spousal limited access trust as long as you have a provision in the trust which says that any distribution to the spouse must be approved by another beneficiary of the trust, also known as an adverse party. So did you know that your children, after you do a slat, will be an adverse party? Well, I mean, you didn't know they were adverse parties before, but then by definition, under the tax law, if you have formed a slat, then your children are adverse parties. So watch out for them. If you have that provision in the slat and you give up the right to replace trust assets with assets of equal value, and you have a trustee other than your spouse, then we believe that it will now be taxed as a separate entity. However, Congress accidentally deleted Section 682 from the Internal Revenue Code in the Tax Relief Act of 2017 and has not been able to put it back in. It's just a technical glitch, and we expect eventually it will be fixed. But until then, I can't promise clients that I'll be able to toggle off their slat. So what you can do is put a provision in the slat that gives the trustee discretion to pay taxes of the grantor caused by the slat. But we don't like to do that. Theoretically, you can, as long as there's no preconceived plan. But we don't like to do that. So sometimes instead of putting the whole company in the slat, we'll put 60% of the company in the slat, keep 40% out, so the client can use 40% of the proceeds from the sale and the cash flow to pay the tax. So thank you very much for that excellent question. Let me go back to the content. So Page 28, thoughts and suggestions. Number one, as I said, the spouse can be the trustee and even receive a trustee fee in addition to what's needed for health education and maintenance and support. And as I said, the spouse can be given the right to appoint a independent trustee who can just give the spouse all the assets. Now, number four, I've said let's avoid the reciprocal trust doctrine by not having the beneficiary spouse establish a trust for the other spouse. We just don't think you need to do that in most planning. So, page 30, we always say in the letters and the documents, in the highly unlikely event of a divorce. Whether I think it's likely or not, I'm always going to put that in the document. I don't want to offend anybody. But let's face it, divorces do happen. Now, I don't know about the other advisors here, but my wealthier clients are less likely to get divorced. My theory being that they don't want to lose having all of it as opposed to half of it. And number two, they have fewer issues. When you have a lot of money, at least you don't have to worry about money anymore. So the divorce may be highly unlikely. But what happens if there is a divorce? If the trust is funded with premarital assets, in other words, I have $10 million and then I get married. And this is my 10 million. I put it in the trust for my beloved spouse. What's that trust going to say? In the event of a divorce, that spouse is no longer a beneficiary and my next spouse becomes a beneficiary. But what if I put marital assets in there? What if I've been married 42 years, believe it or not, and everything I own was acquired during the marriage, and I put my 10 million worth of assets in this trust. Marcia keeps her 10 million, and then she decides to do the smart thing and divorce me because I'm never home on Saturdays until about 1 o'clock. So the answer there is, what we commonly provide is that in the highly unlikely event of a divorce, the trust will divide into two trusts. One trust will be a continuation of the slat for Marcia, and I will have no right to control who the trustee is of that. And if we have trust protectors in the trust who have the power to amend the trust, her friends who are the trust protectors will be the trust protectors of her half slat. Now, what happens to my half slat? Well, I get to choose who the trustee is, and even though by the terms of the trust I can't choose myself or a relative or an employee, I'm sure I'll be able to find somebody who will do what I want them to do within reason on the slat. The slat is for the benefit of our children. I can't put my future children in there unless the document says that future children would go in there, and that's going to be very unusual, but something to think about perhaps. And then if the slat started in Nevada, Alaska, South Dakota, or Isle of Man, the Cook Islands, one of the asset protection jurisdictions, then the trust could provide that I would be a beneficiary of the trust, especially after a divorce, which would be an event of independent significance and something hopefully unexpected. So the divorce clauses in the slat are very important, as are whether to have the floating spouse provision or not. We have a lot of sample language here, and many of you have seen this language because they are in your documents. So page 35, replacement of trustee power. Now, typically, that's the grantor has the power to replace the trustee. But if it's going to be funded with marital assets, you could give both spouses acting together the power to do that, and then provide that if one spouse cannot, then the other spouse can. So then if we want to split the gift, we want to make it unlikely that the spouse will benefit from the trust. So we'll say that she can only benefit, or he can only benefit, when all other resources available to that spouse are exhausted and income is not sufficient. So, number 3, and I'm sorry, my computer is being a little bit testy with me here. Number 3, think about IRA and qualified plans going into the SLAT after death. Usually not a great idea, but I'll mention that the proposed regulations on assets payable to an irrevocable trust on death have just came out, and they greatly liberalize what we can do with that. So if you're a planner, we did post our article on this to Forbes last week, and I'm quite excited about these new proposed regulations. All right. Then here is correspondence about divorce and a divorce clause. So at page 55, you see this potential divorce clause. By the way, if you get divorced or you are a divorce lawyer, read your trusts and call us during the time of the divorce. You would not believe how many wealthy people get divorced and don't address or pay any attention to their irrevocable trusts. And then 5 years later, they come in and say, well, what does my trust do? Well, you got divorced. It doesn't do what you thought it did. Why didn't you guys decide what to do with this trust? Why didn't you go to court and reform the trust so that there's one trust controlled by either of you, or whatever it's going to do? Now, our discussion of Section 682 and the grantor trust rules are here on page 60. Let me see what we can cover next. All right, beyond the flat, beyond the installment sale, is the ability to use a self-canceling installment note or the ability to use an annuity payment. So this chart on page 71, if you are wealthy enough to do a SLAT, you should also consider what you can do with the SLAT. I remember finally in 4th grade, I understood what a preposition was. A preposition is anything a squirrel can do with a tree. He can go up the tree, down the tree, around the tree, through the tree, all those things, over the tree, under the tree. So, what can you, as a 73-year-old in December of 2021, do with your SLAT? Number 1, you could do a demand note at only 1/3 of 1%. So you could loan the SLAT $10 million. The SLAT could invest the $10 million at 1.5% interest and earn $150,000 a year, and then only pay you $33,000 a year. And then when you want your money back, you get it back. So that is a note under 3 years. Now, a 9-year note is now about 1.4%. So I could loan money to the SLAT, or I could sell assets to the SLAT in exchange for a very low note. And with inflation coming up, that's going to be very useful. A note of 9 years or more is only about 2% now. But for a 73-year-old, there's something else you can do, and that is called a self-canceling installment note. Let's say that this 73-year-old is not in really good health. You can do, instead of a 1.89% note, the 72-year-old has a life expectancy of about 12 years. The average 72-year-old alive today will make it to age 84. So I go to my number cruncher or my Tiger Tables software or whatever software program you have, and I see that instead of a 1.89% note, I can do a 6.587% note, payable interest only. And if and when this 73-year-old dies before the note comes due, the whole note is out of her estate for estate tax purposes. Now, I've done these notes for people who were about to undergo quadruple bypass, saying, you know what, the chances are I'll come out, but if I don't come out, the note vanishes. If I do come out, then we can turn the note back into a 1.9% note. So when you have a client who got a bad diagnosis, which is very sad, the happy part of it is, and I always tell the clients, if you get a really bad diagnosis, call your spouse first and me second, because we can convert your notes to self-canceling installment notes or into private annuities. Now, the service, believe it or not, doesn't like self-canceling installment notes. And they say in order to do one, you have to be of reasonable health. But if you want to do a private annuity, which is, in this example, you give the trust $1 million and the trust gives you back $93,000 a year for the rest of your life. There's no balloon at age 85 for this person. And whatever he or she has when on death is included in the estate, but no part of the private annuity because it stops on death. And under the Treasury regulations, I can do that private annuity arrangement even if the client is in terrible health, as long as they have better than a 50% chance of not dying from any specific disease. So when you first read the rule, you think they need to have a better than 50% chance of not dying within a year. But what it really is better than there's no one ailment that has more than a 50% chance of bringing you down within a year. And if you live a full 18 months, then it's presumed that you passed that test. So hundreds of millions of federal estate taxes have been avoided that I know about using private annuities and using self-canceling installment notes. Now, there is something called the probability of exhaustion test, and that is that I'm really tired. Now, actually, the probability of exhaustion test is if you do an installment sale with a trust like a spousal limited access trust, it has to have a lot of assets in order to do the installment sale. For example, it's a complicated calculation done by hand that Ken Crotty or Brandon Ketron or Jerry Hesh knows how to do. I don't remember how to do it. But for a 73-year-old, if you were going to sell $10 million worth of assets in exchange for a private annuity, the trust would have to have about $12 million worth of other assets. There has to be a substantial risk on the part of the trust. I believe that the trust has to have enough assets to last at least until year 100, based upon the trust only earning the 75/20 rate, which is right now, I think, about 2%. So that is the private annuity. The other idea would be the GRAT. So you could make the spousal limited access trust a grantor retained annuity trust, where I give it $1 million and it pays me back $344,000 a year for 3 years. And then whatever that million grew to after during those 3 years is out of my estate, but it still benefits my spouse. And if the IRS doesn't like my values, at least if my values were done in good faith, then there's no gift tax issue. I simply get more assets back from the GRAT. Page 72, we have our Bloomberg tax article called Slatopedia. You are welcome to read it, and hopefully you'll even like it. Our discussion of reciprocal slats is on page 79. Then we have a sample letter to clients talking about the slat. And here's some more slat wisdom for you, or practice for you. Page 98, what put more than 12 million assets in the slat by accident? I'm putting 40% of a big company in there. The valuation report says it's worth 11 million. The IRS says it's worth 15 million. Do I have to pay gift tax? And the answer is no. I'm going to use a valuation adjustment clause. I'm not going to say I hereby give 40% to the slat. I'm going to say I hereby give a percentage to the slat, which will be based upon a fraction, the numerator of which will be $12 million or whatever remains of my estate gift tax exemption, and the denominator of which will be the company, 100%. And it is my understanding that it is worth that I'm giving approximately 40%. But this will be adjusted when I get my valuation report after I make this gift, and it will even be further adjusted if a court of competent jurisdiction determines that it was really worth more than what my exemption was. So we call that a valuation adjustment clause. They are commonly called a Wandry clause, W-A-N-D-R-Y. Everyone was able to learn about the Wandry family, so we saw their dirty Wandry in the case where the IRS said these valuation adjustment clauses won't work, and the tax court said yes, they will work. Now, the Wandry case was not appealed, so we don't know whether the appellate courts will uphold a Wandry clause, but since the Wandry case, there's been some case law which has been somewhat favorable to these. But what if the IRS says that's not good enough? We think you put $20 million into this slat. Well, then the slat will have a contingent marital devise provision, which says in the unlikely event that I contribute more than my exemption, the portion that I gave that exceeds my exemption will go to a trust to pay all income to my beloved spouse, and my spouse can direct where it goes when she dies. That qualifies for the marital deduction. If you're not married, then you can either get married to have this provision or do an overflow provision to your favorite charity. You could even and maybe use your community foundation as the charity, because then if they actually receive a distribution, they're generally going to do what you ask them to do with them, for them from a charitable standpoint. When an IRS auditor sees these provisions and sees a Wandry clause, they're going to be less likely to challenge what you're doing if you're using these conventional provisions. Page 99, I had a meeting with a client this week, and he said, well, when I did that 212 contribution that you told me to make from my own assets, I flubbed up and took it out of our joint account. Am I okay? And I said, well, you're okay as a person, and I still like you, but you're not okay from an estate tax standpoint, because you're the trustee of the trust and you're a beneficiary of the trust. So half of the trust is going to be subject to estate tax in your estate. But thankfully, we have a savings clause in this trust that says that if you contribute to the trust, then it will be divided into two trusts. The one that you contributed to with your own assets and the one that you contributed to with her assets, your spouse's assets. So we need to divide the trust into two, and you need to resign from being the trustee of the separate trust that was funded with your wife's assets. And you need to do that 3 years before you die, because there's a 3-year look back on certain things in the estate tax law, and that is one of them. So he may go buy term life insurance to pay for the estate tax that would occur if he dies within the first 3 years. Okay, let me answer a couple more questions here, and then I'm going to finish right on time and leave plenty of time for the next presentation, which I am looking forward to significantly. Okay, can you discuss general Form 709 preparation for slats, David? No, there's not time to discuss that, but we do have a YouTube video on gift tax returns by Ken Crotty, which I think has been watched like 15,000 times. And I think that covers everything you really need to know. Okay, somebody has to have a spreadsheet to compute the probability of exhaustion test, but I haven't found one. Richard, when you find one, let me know, or maybe you and I can do one together. Lee says, and by the way, Lee's pretty smart, so whatever he says, it's going to be pretty good here. If a slat is funded initially without an installment note, can it be leveraged later with an installment note? Absolutely. And is that without utilizing the additional exemption amounts? Yes, that's true. And I will say, Lee, you are one of the top financial advisors I've worked with because you have a thorough understanding of this. Some financial advisors read a brochure on it, and some financial advisors spent hours, and you spent the hours. So I thank you for that. Okay, let me see if there were any other slides that I wanted to cover. Oh yes, I wanted to cover one last slide. Let me see if I can move it here. I hope you'll be moved also. This is a new Florida law. I'm always excited about new Florida laws. Under the new Florida law, if the governor signs it or if he lets it go and doesn't veto it, then effective for slats formed July 1st, 2022 and thereafter, we can provide that the grantor will be the beneficiary and receive amounts as needed for health, education, maintenance, and support after the death of the spouse. So this will be very good for people who have spouses with short life expectancies. If I had a spouse with a very short life expectancy and I wanted good creditor protection, I could put all my assets into a trust for my spouse's lifetime benefit. And then after my spouse's death, I could be the beneficiary of that trust, and it will be creditor protected because the new Florida law says that I will not be considered to have been a contributor to that trust. And therefore, my creditors won't be able to get into the trust, and therefore, the trust should qualify as a slat. So that's one of the reasons why when we do a slat, do I do it in Florida where I can't be added back in under any circumstances, or do I do it in Nevada where I can be added back in under certain circumstances? But now it's more likely I'll stay in Florida because I'll be automatically added back for slats formed after July 30 if my spouse predeceases me. But how often does the spouse predecease the grantor of a slat? Maybe 15% of the time. Not that often, because usually it's a husband who's older establishing it for a wife who's not only younger, but commonly healthier. So that concludes my slatateria of slat. And I'm really glad now to introduce a speaker that I've been looking forward to hearing. I believe, Kelsey, am I right that we can just go to the first slide? Okay. Raul, while I'm going to the first slide, is your audio working?
I think so. Can you hear me?
I hear you. Absolutely.
Okay.
So, Raul has over 35 years experience, and this is really interesting because it's very, very rare that I find someone that I can talk to who is in academia now, in startups now, with extensive experience with Fortune 500 companies. And like most engineers and scientists, I don't have the slightest idea what he did for those Fortune 500 companies. So Raul, welcome. And first, tell us about yourself, because I think it's very interesting.
Sure. You know, as it says there, I'm a computer scientist. I got a PhD in computer science and did a lot of work in that area in big companies. I used to run a big division of a public company. Came down to Florida, tried to retire, got bored, and then started to just do startups. Had a couple of successes with startups. And now I have my own little research institute where I work on ideas and we kind of spin them out into companies and just try to keep myself busy.
Nice. Well, when I read what you sent me on estate planning, I was just like, God, this is going to help us further develop the estate planning profession. And when you get a fresh view from somebody like you.
Good. Would you like me to put up my slides?
Yes, please. They've got to be better.
Let me know if you. I don't know about that. I haven't got the dummy, but let's see.
Here we go.
Let me know if you see the slides. And,
they look great. Yep.
All right.
Cover slide.
So let me get going, and I think as the title says, and like a lot of people, estate planning is not something that's sort of fresh in mind for most of us. We're doing whatever we're doing, and at least for most of us, what happens is, early in your career, you're just trying to support yourself, and then, a little bit after that, you have a little bit of money, and you kind of do the usual things, and it's, if you're very lucky and things go your way, that you have enough money that you can actually do something, and then the question becomes what? And so I just wanted to give a little bit of my journey on trying to learn this field and give some perspective, which hopefully will be helpful for the people that are professionals in the area. So just a little bit background on me. So as I said, I was a computer scientist, electrical engineer. So the stuff you see in front of you is stuff that I've worked on. The thing on the very left is a microprocessor. I used to be a microprocessor architect for a company called Digital Equipment Corporation, which was then, that group was acquired by Intel. So those kinds of processors. It's the stuff that the picture that's in the middle top is actually the design system to build the things on the left. And so I was in a company that did that. The stuff on the right is a wireless power company that I built here in Florida, and we sold it to Qualcomm. And what I do these days, just for my I guess day job, whatever that is I work on autonomous vehicle research. That's the bottom middle picture, where we're trying to figure out how artificial intelligence sorts of technologies can help with autonomy. And then the other area that I work in quite a bit is education. So I ended up giving a TED talk on education. So I want to give you this background because what you don't see in there is financial planning, estate planning, and all of that sort of stuff. And I guess I wanted to make the point that, many of the things that I do very much used to complexity. There's technical complexity. If you think about trying to build autonomy in a car, well, just as a slight aside, if you ask most people, what does it take to get a license? They might say, 6 months, enough to learn how to drive a car. For a human being, in order for us to replicate that for a car, it turns out it's a lot more complicated. And the reason is, if you're a human being, you understand things like, if you see a leaf on the road, you can just run over it. But if you see stones, you can't. And all that experiential knowledge that human beings build up, since they were born, is actually very much of a part of how do you operate in an environment. So the AI systems have to figure that out. And then legal complexity. So when that's actually the deal deck from the Qualcomm transaction, and I know a lot of that deal deck pretty intimately. And so I guess my real point was, it's not that complexity is not new to me, but kind of walking into estate planning, I kind of my first reaction is this all unnecessarily complex? And kind of a lot of the people I was dealing with, there's a lot of disaggregated players. There are CPAs, there are state attorneys, there are life insurance companies, and investment professionals. It's as a person that's trying to figure this stuff out, it's not entirely straightforward to connect between all these people, nor even understand sometimes in the beginning what their competence sets are, so how to classify them. As we've discovered, there's a lot of technical jargon. By the way, my field has, my computer science has a lot of technical jargon. And the issue is, technical jargon is necessary, as it is in my field, but what we always talk about is, how do you turn that into things that the person consuming it can absorb at the level that they need to. And so abstraction, this idea of abstraction, is very powerful. Most of you use computers, and you look at things like in the operating systems, you have ideas such as folders or windows. These are all terms we came up in computer science because they were familiar with people, not because they're necessarily connected to the technology underneath. And that bridging it turns out to be very important because it forms mental models that people can use in order to deal with the complexity of the things that are underneath. The other observation is every single person I dealt with wanted very similar information repetitively provided in their own format. And I just kind of wondered, well, why isn't there some standard for this? We have health records. Why aren't there kind of, health, as it were, financial records that are, of course, securely held, but can be easily transmitted, so we don't have to repetitively do the same thing. And then finally, a real obsession with tax avoidance. Of course, tax avoidance is very important, and not to say it's not very important, but I get the feeling this is viewed as the primary value generator. And it kind of reminds me a little bit of, there's this movie, George Clooney movie, I think it's called Up in the Air, and he's the main character who has an interesting view on life, actually is obsessed with airline points. And then there's some interesting conversation in the movie where when somebody calls him on, the fact that he's obsessed on airline points, he says it's actually all about the points. And of course, that's actually not what it's about. So I think the issue is that, from my point of view, the tax avoidance is extremely important, and there's a lot of focus on it. But that's not sort of the bigger picture. So kind of what's the bigger picture? From my point of view, is there's sort of as a person trying to figure this out, the first thing is how do I develop my objective? Once you get past the point of you don't like when you get to a point where the money you have is actually material and can actually change people's lives, both for positive and negative. What should the objectives be, and how should I think about those objectives? It turns out to be the most important thing. And if you're just walking into that, or if you're not intimately familiar with these concepts, then what you really want is experiential learning from others that are trying to deal with the same issues. And you want to understand variations of what's happened and all of that sort of stuff. So development of objectives is really a big part of, I believe, what people would value and do value. The second thing is risk assessment and management. One of the things that I always wonder about when I hear talks about things where, some edge condition is being talked about relative to the IRS or the tax court or something like that. Of course, this is extremely important when you're at that level. But if you're, as a client, you're kind of thinking, as a customer, you're kind of thinking about long horizons. And you're thinking about long horizons, presumably, in the context of maybe you're not the only person that has to make some of the decision making. And also, do you want to intimately be connected to the bubbling tax code and the regulatory code? So kind of a understanding of risk at multiple levels, and kind of trying to figure out what in the engineering world we would call it robustness, right? So you can engineer something where it's extremely high performance, like maybe I have to use the car analogy. It's high performance, but kind of brittle because any little thing can break it. Or you can engineer things that have much higher robustness, but may not be the highest performance. Okay, and so that idea is something that's extremely important in my view, but doesn't come across when I deal with a lot of the professionals in this space. And of course, the tools, the legal structures, they're there. They're to be used. In my mind, they're sort of tools, so therefore, in many ways, they're their lowest value statement. Just maybe one more thought here. What I wonder about when I kind of walked into this is why is every lawyer building their own unique version of similar information in terms of legal language? almost isn't there a preferred method of common language that's been tested? And just using the analogy of what we might think about in engineering as well. And so that's kind of just a thought that came to me, because what you don't want is if the objective is to be the same, but the crafting of the language actually causes the issue, right? So how do you deal with complexity? Underneath you've got these tax codes, you've got real life conditions that are causing all sorts of things to happen. And certainly in engineering, what we do is we kind of have this intense idea of abstraction. So just, since I'm going to just use the analogies from computing, because most of you are used to using computers, but we kind of build these abstractions where in computing where you don't know about the transistors that are underneath your computers, right? So you don't deal with those transistors. You don't even deal with the operating systems. We keep abstracting up to these things called Windows and even above that with websites and so on. So the idea of higher level abstractions that people can deal with is very powerful. And the question is, what are the right abstractions in this space, right? The second thing is visualization. It's extremely difficult to see dynamic information, especially with when you're trying to stress test, various things that can happen. Who dies first? Who dies second? A bad spouse syndrome or something like that. It's extremely difficult to see that in a textual form, even in a PowerPoint form. You kind of want to see it in a much more visual context, and so that's because that's how human beings absorb. In fact, to tell you the truth, human beings absorb things in a visual form, but also in a storytelling form. Storytelling is extremely important in terms of how people absorb information. And then finally, in this complex set, like when we think about sort of, in my world, complex software systems, and there's a lot of uncertainty and risk, the way you manage that typically is, there's a methodology called Agile, but all it really is saying is, you don't try to bite off everything. You sort of build an incremental process to get there. And what you're doing is you go to the next step and you sort of build comfort levels on where you are. Then you go to the next step after that, and so on. And so the question is, what does that look like in this space? And of course, all of this is based on the thing we talked about before, what the objectives are that you've chosen to go after. I think I try to take a shot at what this means in this space. There's this notion of how you deal with complexity. Is first of all, you have to sort of contextualize what the space looks like. You have to build a map of what you're dealing with, and that typically consists of what's my world today, where do I want it to be, how can it change, etc. The players that are in this are humans. So, human frailty, as it were, is a part of this picture. And then the pathways or the sort of the step-by-step process that can help with this exploration, right? I guess the point I want to get across is exploration and collective knowledge is typically a key part of how you absorb this information. So I guess in this world, and I don't claim to be any expert in this world, but what I kind of, in most of the conversations I walk into with professionals in this space, whether it's CPAs, life insurance companies, or life insurance agents, and all the professionals, they're very much operating the equivalent of, if I started talking to people about low-level operating system drivers, right? They're talking about low-level mechanisms often, and kind of where nobody seems to want to start is there are high-level structures that have basic properties that we haven't absorbed to the same levels as the professionals, right? There's corporations, there's trust. There was an original reason for trust. Yeah, there are sort of over time, there have been movements of these basic structures and equity structures and so on. So there's sort of this very high level kind of building blocks that exist that various people have various understandings of, right? And so without that level set, what happens is when you walk in with sort of loan payback structures, or there's sort of this understanding that people understand this, but they don't, right? And so without that understanding, it's very difficult to absorb it. And then, of course, you've got the human behaviors and all of that. Let's see. I think I'm being somewhat repetitive here. Okay. Yeah, so as we're dealing with this, what are the kind of impediments to progress? So I think business models are a bit of an impediment to progress here. So, of course, the people that have products to sell, they have commission-based structures, and so there's this kind of feeling of implicit bias, and so that gets in the way of trust, right? And so that, so therefore you can't do much in that space. Also, there's a lot of people, especially on the investment side, that want to have structures which are, let me take a percentage of your estate and just manage it for you, and this kind of thing. And so, you kind of wonder about whether value is being generated or value is being produced in that space. And, I have my own view on it. Others may have a different view. And then even time and materials, I'm going to charge per hour, things like that. It's probably the best of the three so far, but, it's still sort of this implicit, non-aligned relative to the client. And so the question is there a business model that's sort of much more aligned that can be invented here, where it pays to have a much bigger and it pays to have a much broader and deeper relationship where there's joint interest. Let me just give you an example of this. When I did the Qualcomm transaction, the whole market capitalization for the company that I had, White Power, was less than $1 million. And when Qualcomm actually gave us the offer, which was quite interesting, we had to go off and get corporate attorneys, to help close the transaction. And we were told that would probably be, several $100,000 to close the transaction. And if you have a market capitalization of less than $1 million, what that means is that, if the transaction doesn't go through, then you can be out of business. So I actually just went around to the top firms in the U.S., the corporate attorney firms, M&A firms, and I said, here's my problem. I want a solution where I'm capped on the low side and you get participate on the upside. And I actually got a deal like that, actually with a very good firm in Tampa, and we set up such a structure. So, and it worked actually fantastically because they were highly aligned with what I was trying to do, and they never tried to get ahead of me, in terms of the work they actually did, and they were also sensing whether the deal would close or not, and in that sense, they were very, very useful in monitoring the overall transaction. So the question is there a structure here where this can be done? Because if there is, I think it starts going in some interesting directions. So, like I said, I'm a computer scientist, and so when I look at the space, I often start thinking about high-tech sort of things that I wonder make sense here. So one thing that kind of makes sense to me is communities for customer learning. That is, high net worth individuals that that they're not talking about the details of their estates. They're talking about sort of how they deal with common issues, and that turns out to be extremely useful, right? So even as I went through my own process, I just sort of started reaching out to other people, and the journey that you see, the links you see down there is sort of some level of result of that. But I just wonder if there's a much more active kind of thing that can be done there, and where people can share their how they've dealt with it, or ask other people, and therefore there's some collective learning that goes on. Automation of the standard norms, forms of legal structures. So again, a lot of these standardization, in my mind, has power, simply because from a client point of view, I know if something is standard, it's been tested in various ways in other places, and somebody specialized on it. And so I noticed in the area of private foundations, as an example, people are, not only standardizing, but also building the services behind it, so that the management tasks are minimized and things like that. Visualization products and with what if analysis, that seems ideal. Somebody's going to do this if they haven't already done this. And then sort of open source for standard contract terms. Again, I think I mentioned this. Well, it's not clear to me why the same things have to be done differently at a per lawyer level. So, by the way, as I went through this process, this has been over about a year, I guess. I just wrote down my experiences, and so if you're interested, you can read it. And the starting point, as you'll see, is I started to go down the process of how do I even think about objectives, and I wrote this title because I think the objective is managing family happiness, but you never know about the disgruntled spouse, I suppose. Let me see. Oh, okay. Well, I just thought, since Alan has a very interesting sense of humor, I would add my own take at it. So this is actually, I wrote this in a Forbes article, but this is comparing what's more sustainable and a better solution for autonomous transportation, a donkey or a Tesla. And this is like sort of the standard marketing chart. So you start out with, green, so, obviously a donkey is excellent, it's green in, green out, and Tesla's pretty good, electric, right? So homing mechanism, the donkeys are very, very good at, getting home, and I think Teslas are okay. I'm not sure they're as good as donkeys, but they're okay. Conflict avoidance, as in avoiding hitting things and avoiding objects and things like that. Self-preservation, evolution has built a very, very strong sense of self-preservation. So conflict avoidance for donkeys is extremely good, and Teslas aren't bad. Don't jump off a cliff, though that's always good. It's a similar thing. And then, of course, finally, if you have two donkeys, you can get a third one. You can't do that with Teslas. So that's kind of what I had. Alan, I don't know if that was useful, but I don't know if the audience has any questions.
Yeah, let me see if we have, let me find my question box here. My question box disappeared on me. Let's see here. So yeah, one question here is, as an estate planning lawyer, what would you recommend for a first meeting that you didn't see, that didn't happen for you in first meetings?
I think for me, it would have been useful to just get a little perspective on what this whole thing looks like, right? I mean, what like I'll say the very, very highest level objectives, right? What are you trying to do? How are you trying to do it? And do you know what you want to do? That was the thing that I found missing, because you know, a lot of the meetings came down to what are your assets? Let's get those. And then the objectives were sort of asked for, but you know, of course, in the beginning, I didn't really have a good view on them. So how you build those is like, how do you build your objectives? Maybe is a question, and to what degree of maturity, you know, does the client in your guys' case have that? Some people may have everything figured out, but a lot of people don't. And to the degree it's not figured out, is the degree to which the rest of the process is going to be very noisy.
Right, right. And then aside from creditor protection and estate tax avoidance, which honestly is what most affluent clients are calling about, what do you think the objectives are that we should remind clients about more often?
You know, the client has to, in my mind, the client has to build some kind of model of where they want to go, and most of us haven't thought about it, right? I mean, we're doing whatever we're doing. I mean, you know, just this process of thinking about, okay, you know, if there's kids, they might be grandkids. There is the transfer of assets. You've got these high level things. I mean, even something as simple as a conceptual model where you have, of course, income taxes that most of us are familiar with, but then they have estate taxes, and then even the mechanics of how these things intersect with what happens in your life. You know, these are not, for most people, for most of us, they're not clear things, right? And so part of it is just ramping up. For us, it's ramping up to a level that we can understand in what context you're having the conversation with us.
Right, right. Okay. Here's one. Understanding the behavioral bias is crucial in decision making. Dealing with the tax code is different than dealing with people's emotions, psychology, and biases. David made that point. So we should be less code heads and more caring, I guess.
Not so much caring, but you know, it's sort of this basic question, right? Like, let me give you an answer. Let's say that. Let me give you an extreme example. Let's say I have a point of view for whatever reason. I'm going to give everything away to charity. Okay. Well, the conversation you're going to have with me in that context is very different than, you know, the other side, right? So like the first conversation, it seems to me, is sort of what do you want to do? And you know, like I can tell you that at least if you would have talked to me a year and a half ago, I hadn't thought about it enough to tell you what I really wanted to do. So because most of us are in our professions, we're kind of looking down what we're doing, and we've got the next professional thing we're working on. So it takes a while, in my view, for the, you know, to kind of even learn what the direction ought to be. And so to the degree, and this is going back to one of the slides I was talking about. So I know this doesn't pay, but to the degree that somebody can help with helping develop the objectives, and I don't mean tell somebody, but here are what other people did. Here's different circumstances. Some people went in this direction for the following reason, right? Because once that starts getting laid out, I think then you can start developing strategies and, you know, things underneath and so on. But in the beginning, we're all on the bicycle wheel or the hamster wheel, whatever that right the term is, and it's very difficult to sort of get yourself above it enough to know where to go.
Let's go back to cars now. I want to hear about cars.
Yeah.
What am I going to be driving, or what's going to be available to me in 10 years?
It's extremely likely that public transportation systems will have a fair amount of autonomy because they're sort of can be fixed routes. Delivery vehicles, little delivery vehicles, pedestrian follow me vehicles are going to be there. But I'm assuming you're asking the question from an autonomous vehicle point of view. But like public passenger car, traditional passenger cars becoming autonomous, that's the longest pole. And the reason it's the longest pole is there's a lot of things that we have yet to figure out. Just as an example, if you're driving with your teenage daughter, I don't know if I'm being there, and you're teaching her how to drive, and she's very nervous because they haven't had the experience of driving. You can tell that immediately from their behavior, right? You can just, as a human being, you can just see it, right? Okay. When an autonomous vehicle is in that similar situation, we don't have a language to transmit this information out. I don't know what I'm doing right now. Yeah, I don't know if you have a Tesla or a Mercedes or whatever, but you actually need that, because if you don't have it, it actually becomes a safety issue. And then you get into all sorts of other issues, since you guys are actually I forgot to mention this. Okay, so autonomous vehicles are new. And so people believe, geez, the law is always lagging, and so it's going to eventually catch up. And, that's kind of the general headset. But what's interesting about autonomy is actually there's a whole body of law that already exists for handling autonomy in terms of transportation. It's called equestrian law. And it's from 100 years ago. And they had all the stuff pounded out about, okay, if you have accidents, what happens is, it's your fault if this happens. By the way, and there's also this concept that they had in the old days where the horse just went crazy. Nobody knows what happened. I guess what I'm trying to say is that from a technological point of view, things will progress, and they'll progress in a funny way, kind of small going up, as it were, small use models and so on. The legal structures, I think, will kind of, I guess, lag on that. The big thing will be there's a lot of big models, business models that will actually shift along the way, right? So like we use them, just to give you an example. Most of us may order a pizza, okay? So that's, if you think about it, or you go to the grocery store like Publix. If you think about it, it's kind of a funny thing we do. We get into a multi-ton vehicle with ourselves and our time. We go to a Publix. We take, 5 pounds, and then we take a multi-ton vehicle and bring it back to our house. If you just think about that seems like, what's that about? From all sorts of points of view, right? And so you should expect what will happen is in the future, you'll probably just get on a phone and say, deliver this to me, and a little robot will just deliver it to you. You don't have to do these multi-ton vehicle trips, right? So that kind of stuff, automated parking lots, all of that sort of stuff is going to happen, and it's going to slowly just start seeping in, and you won't even notice it.
Yeah, beautiful. Okay, well, I can't thank you enough, Raul. That was a great presentation, kind of thinking through different industries. I'm sure we'll have you back. Your article that I read was beautiful. J. Alfred Prufrock poem on works, fantastic. So thanks everybody for attending, and we will see you next Saturday at 11 if you are a glutton for punishment.
Bye-bye.
Thanks.